John, I'm going to begin with you because you're arguably the most bullish person who's appeared on this program that I can think of. And our last conversation was why you were even more bulled up than you were the prior time we had spoken. And here you go with the minutes today, which were decidedly hawkish. And I'm wondering how you can remain so positive on stocks in the face of all that lies ahead. Explain.
Well, Scott, great to see you again. A couple things that I would say. If you go back historically, there have only been 3 times we've seen the S&P down by this magnitude. And the subsequent years following those declines of 19% or more, the average return was 27% in the market. So historically looking back, those were times to be bullish on equities. If you think about near term, I think you talk about seasonality a little bit. You have I'll step back before I go to seasonality with the January effect. If you look at price momentum, one of the most prevailing factors in the market, you see the widest spreads between good momentum stocks and poor momentum stocks going back historically when you look at last year. And when you dovetail that with a January effect, I think you could see a significant pop in equities. And I think that could set off a near-term catalyst for stocks. Personally, Scott, even though I don't know if the Fed's going to pivot or not or when they're going to pivot, I think it's becoming less relevant because the second derivative is moving in our favor. They're not going to increase by as much. You're seeing rates peak to roll over. The 10-year's already roll over, 7-8% this year. And you're not going to have a Fed that's going to be able to be as aggressive, even though they want to keep hawkish language. It's going to be harder for them to continue to raise rates. And you are seeing inflation roll over. So I think all those things are falling into place. And Scott, the dollar's already rolled over. Since Halloween, the dollar's rolled over 8-9%. So there's a lot of things that are lining up. I would argue you want to be stepping into equities when inflation is peaking, when the Fed is entering the end of their rate increases, and when you're seeing valuations very distressed in cyclicals, consumer discretionary, industrials, and banks. I mean, banks are tremendous values here. Nobody wants to step in because they're worried about a recession.
Well, I almost feel like saying, well, who cares whether the magnitude of how they hike? If they take their foot off the gas a bit, but they still put the car on cruise control, and they get to a further destination than you think they'll get to, does any of that matter, what you just said?
Well, I would argue that valuations are the biggest predictor of future returns. If you look at the CAPE, that is going to be the biggest predictor of future returns. And if you look at valuations, I mean, Scott, for example, the Russell 2000 value is trading at 10 times earnings. I mean, that's cheap. You go look at any historical, textbook on valuations, that is very cheap. So we are seeing very retracted valuations in the small and mid-cap space. And I would argue that that's a better barometer for value than trying to identify exactly when the Fed is going to pivot. I think that's being a little bit too myopic in that specific area. If you look at what's going on in the emerging markets, I'll pivot there for a minute. We're seeing really tremendous opportunities there. And, China, for example, Scott, that's up 40% since Halloween. And the S&P is down 1%. Nobody wanted to buy emerging markets. Nobody wanted to step into China. You're seeing those become very attractive to investors that are willing to take that risk. I mean, you're not going to have a large return if you're just looking for safety. The 2 year is an interesting place to sit and collect some income, and maybe you get some appreciation if those move lower, if the prices move lower. But I would argue that equities have a much longer trajectory given the discounted valuations. I mean, Scott, if you look at Zoetis, for example, a stock we like in pharmaceuticals that's tied to more discretionary spending, has emerging market sales, it is trading at the steepest discount to big pharmaceutical companies going back to the fourth quarter of 18. And while I agree with much of what Josh said, one thing that I would maybe push back a little bit on is looking just at the absolute dividend yield for value, because Merck, Johnson & Johnson, Pfizer, those have significant yield premiums relative to Zoetis, for example, but they're much pricier. They're all-time high valuations. So I think you'd be very careful searching for yield in this market because the defensive areas are pricey.
All right, that's a fair comment, at least how you ended there. Let me do this. Brenda, give me your view here, and then we'll have Josh get in the mix and give us his opinion on what he's just heard. Brenda?
Sure. And I agree that some of the defensive areas are pricey and that some valuation areas within the equity market are still very attractive, particularly those outside of large cap equity. But when we look at the risk reward for large cap equity versus bonds, we really think that bonds are looking more attractive, and we've been adjusting our portfolios accordingly. When we look at, I think that is absolutely a huge game changer when you can earn 4% in a money market fund where there is no downside. I think that's different. I'm not suggesting everyone should put all their money in a money market fund, but that dynamic has really changed the investing outlook materially in our view. And we think if you stick with still investment grade bonds, you can earn 5 to 7%. And even as the Fed raises interest rates, if they continue doing so, there may be some short-term pain associated with bonds, but I think in the ultimate scenario there, we think that would likely lead to a recession, and that bonds would really resume their historical role in portfolios as being more of a protector in an equity market correction that we think would likely unfold in that scenario. So we really think that the dynamic has changed with bond yields being as high as they are today, and that has absolutely made the asset class a lot more attractive in our view.